Oh, what's good, my fellow stock market trader and investor homies? It's your boy, Kevin. We're going to talk about what's going on in the stock market and how I actually think that the collapse of these banks like Silicon Valley Bank, SVB, may actually help the stock market, at least in the short term. We're going to talk about the banking collapse, talk about the details, the federal government stepping in and stopping the bleeding, at least for now. They have stopped the bank runs for now. But I actually think what's happening may force the Federal Reserve to pump the brakes on the tightening. So we're going to talk about how this may help the stock market in the short term. Let's break it down. Let's get it. All right, so we got the charts pulled up on the screen right here. Today, everybody was expecting a giant collapse in the overall market. That's not what we saw. That is not what we got. We started the day gapping down. Here you can see we started the day gapping down a little bit, right? Not substantially. I think it was less than 1% in the overall market. We opened up, got some selling right here, but we bought back up instantly. And for the rest of the day, for the majority of the day, we rose back up. We closed the day down a little bit. I think a little bit in the red. Actually, not even. We closed the day in the green. And everybody and their mother was expecting that we were going to have this horrible, horrific red day, and that's not what we got. We got a pretty unexpected green day in the overall market, and it was choppy, but it was green. And I actually think that this Silicon Valley Bank situation may force the Fed to rethink what they're doing. All right, so we're going to talk about that. First, let's discuss what happened with Silicon Valley Bank. I'm sure most of you guys are familiar with the situation, so I'm not going to go into too much detail about what happened. But basically, you have this bank in California. This bank specialized in lending and serving. Their customer base was venture capital firms. These venture capital firms were investing in startup businesses. Obviously, investing in startup business is a risky operation. They don't have a customer base. They're building from the ground floor up. It became risky. People heard that the bank was in trouble. Customers heard that the bank was in trouble. So they rushed to the bank trying to withdraw all their money. It started a bank run, and they did not have enough capital to cover all the requested withdrawals. The Fed step in, they seize the bank, and now we are where we're at today. All right, so the Fed step in, they take control. Here's what they're doing in order to stop this from happening at other banks. So number one, all deposits in the now defunct Silicon Valley and Signature banks will be fully recouped without using taxpayer money. That's key right here, without using taxpayer money. The Federal Deposit Insurance Corporation, the FDIC, announced Sunday with the Department of Treasury. All right, so taxpayers aren't going to be paying for this. That is a big deal. Also, everybody's getting their money back, all of their money back. There was some speculation that these customers of these banks were only going to get the $250,000. When you deposit money in the bank, you usually get a term sheet when you open that account that says that your deposits are insured up to $250,000. Well, most businesses of any decent size are going to have more than $250,000 of capital in the bank. So there was some concern, there was some speculation that people would be out money over $250,000. Then it came out that that wasn't true, that they were going to be able to withdraw up to $250,000 within the first day, but they were going to have to wait on the rest of the money. That freaked other businesses out at other smaller banks, so they started running to the banks, and then the feds had to step in and say, hey, wait a second, we're going to give these people all their money right now. So everybody has access to all their money. Number two, banks that are low on cash or holding too many securities like treasury bonds, which have tanked in value following interest hikes from the Fed, can get year-long loans from the Bank Term Funding Program, the Fed also announced on Sunday. All right, so why would these treasury bonds be a problem, right? Treasury bond yields have skyrocketed because of these interest rate hikes. So when you go and deposit money at the bank just doesn't put your money under a pillow in their bedroom. They're depositing that money in other assets like bonds so they can get an interest back on your money. They're using your money to work for them. Well, they went out and bought all these treasury bonds at a lower interest rate than today's interest rate. So if they want to go sell those bonds, who wants to buy a bond at 1% when they can buy it at today's price, which is over 4%? So those bonds lost a lot of money. They were underwater on those bonds, and they could not get out of them in order to satisfy customer withdrawal requests. All right, the new loan program allows banks to temporarily exchange treasury bonds and other securities with the Fed for their full cash value as opposed to their vastly diminished market value. The Fed will hold the securities as collateral and release them back to the bank after it pays back its loan. President Biden and hedge fund investor Bill Ackman defended the measures Monday, saying that they protect the economy from further bank runs and credit freezes. Biden, Ackman, and Janet Yellen distanced the new policies from the financial crisis of 2008. All right, according to Biden, the money will come from fees that the banks pay into the FDIC. So it's not going to come from you or me, the average taxpayer. It's going to come from these banks paying into the FDIC. All right, so that covers where we're at today, what the feds are doing to stem the bleeding from these banks failing. All right, so why does this matter? Why is this going to help the stock market? I actually think it is going to help the stock market, and here's why. All right, so Jerome Powell was testifying in front of the Senate about a week ago, right? And it absolutely crashed the stock market. Here's some of what he had to say.
Semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. We have more work to do.
More work to do.
Our policy actions are guided by our...
That investors took his speech as him saying, we're not even close to being done yet. We're going to have to continue to raise these rates, and we're going to have to raise them more than we initially expected. If you go look at the overall market chart, and you back off, let's look at a daily chart. Here's where he was talking in front of the Senate, okay? Boom. And look what happened for the following few days, right? He's testifying, boom, the market sells off. Why does the market sell off? Because the market takes his speech as him saying what I just said, that he's going to have to continue to raise rates, the Fed's going to have to continue to raise rates, and we got a long way to go. Well, the market didn't like it, obviously, and look what we got, a sell-off. Well, what does the bank collapse have to do with this? Well, the CME Fed Watch is a tool that predicts these interest rate hikes and how big these interest rate hikes are going to have to be. Okay? Initially, after his speech on the Senate floor, the anticipation of a 50 basis point rate hike was like 75-80%. Now we're at a 38%. There's still a 62% chance. You can see up here, 62% chance of a rate hike. But now we're predicting that it's going to be the 25 basis point rate hike. Okay? So I think it's going to be that 25 basis point rate hike. Why? Because you can't just freaking slam these rate hikes. You can't continue to raise rates and diminish these treasury bonds that these banks have bought a year ago that weren't worth anything now. They're not worth anything now. So this New York Times article goes on to basically agree with my thesis that the March 22 interest rate decision is just a week and a half away, and the drama that swept the banking and financial sector over the weekend is drastically shaking up expectations for what the central bank will deliver. The Fed has been raising interest rates rapidly to try to contain the most painful burst of inflation since the 1980s, lifting rates above 4.5% from near zero a year ago. So that's really the problem, right? We had rates at near zero a year ago. Now we're at 4.5%. If these banks bought bonds a year ago, they bought them at a very low interest rate. Now you can buy them at 4.5%. So they're having a hard time moving off those bonds. So before this weekend, investors had seen a substantial chance that the Fed would make a half-point increase at its meeting next week. That step up was seen as an option because job growth and consumer spending had been surprisingly resilient, right? The job numbers were better than expected, meaning that was giving Jerome Powell the confidence to continue to raise rates because what he's done so far hasn't impacted the job market as negatively as some thought it would. All right. So, but investors and economists no longer see that as likely. 3 notable banks have filed in the past week as Fed interest rates have failed in the last week as Fed interest rate hikes ricochet through the technology sector, cryptocurrency markets, and up and even usually stayed bank business models. Regulators, they implemented the bailout program. Investors have abruptly downgraded how many interest rate moves they expect this year after Mr. Powell's speech last week opened the door to a late rate change at the next meeting. All right, so basically the article, I'm not going to read the whole article. Basically, it goes into saying that it's less likely that we get that drastic rate hike at the next FOMC meeting. Instead, we'll probably see a rate hike, but just a 25 basis point rate hike. And when the market gets an unexpected move like that, right? The market was expecting the 50 basis point rate hike when we got this sell-off right here from 407 in the SPYs down to 380. So, okay. So that's already baked in. We already have the 50 basis point rate hike baked in this move. So one could theorize that the downside is already baked in. And there's a move back to be had back up towards 407 in the overall market if we only get that 25 basis point rate hike. And it's very, very unlikely, but who's to say we don't get a no rate hike? If we get no rate hike, I could see us back up at 430 in the SPYs. But even with the 25 basis point rate hike, we could be back up at 407, and that's a substantial move in the SPYs. You have the high beta stocks, the Teslas, the Amazons, the big blue chip stocks. If that happens and we get a rally like that in the overall market, those will rally as well. All right, so I do think we get a rate hike, but I'm predicting the 25 basis point rate hike. I think the downside was baked in. People are panicking, and you know what our old pal Warren Buffett says, buy when the blood is in the water, when the sharks are swimming. That's the time to buy, not when everybody's being greedy. Pigs get slaughtered. Bears and bulls make money. Pigs get slaughtered, right? So there's a funny video. You know, Elizabeth Warren and investors really don't get along that often, but she's actually defending not raising rates, chastising Jerome on the Senate floor.
If I understand what you've said and what economists are saying across the board is that when you raise interest rate, there's going to be less money to invest. And that is, it's going to dampen business investment. Is that a fair statement?
I think the idea is to
Makes it more
moderate demand
to invest
so that it can be in better balance with supply. And
so
the current situation, demand is well in excess of supply in some areas of our economy.
More expensive to invest, which in turn is going to throw workers out of work. And when they're out of work,
to be honest,
they
though,
have less money
if those
to spend.
unemployment numbers go up, that's actually good for the stock
increases
market. It's
stop
sad people losing their
companies from
jobs.
spending money to build new plants or to buy new trucks or to hire new people. Right, Chair Powell? When money's more expensive, they're less inclined to do that. I think that's what you just said on asset pricing, right?
Well, in the labor market, you have, as you know, you have a situation where there's a shortage of workers, and there are two job vacancies for every person who's actively looking for work. So Part of this is to get the labor market back into balance.
Well,
supply
I
and demand.
appreciate you call it back into balance. What I'm trying to get at, though, is what does the tool of raising rates do? And
All right, she basically says that she thinks raising rates is a bad idea and that there's other ways to combat inflation, like the systemic supply chain issues, attacking those supply chain issues, which I tend to agree with her. I think rates obviously had to come up off that floor of zero. That was just craziness in the real estate market, and the stock market was running buck wild. But there's no reason to just slam the brakes like it's been happening. Pulling the Paul Volcker out of the hat, out of nowhere, is not doing anybody any favors. We do need to get this inflation under control, but there's no reason to see interest rates up at 7-8%, right? That's out of control. All right, so just wanted to come touch base with you guys, talk about why I think this banking situation could actually have the Fed slowing down. And when the Fed slows down, people are the big institutions, the big hedge funds, they're going to slow down from throwing all their money at these treasury bonds that are showing crazy yields right now, and they're going to get back involved in the stock market. And when those big hedge funds, institutions start buying stocks again, we're going to see a rally. That may not be now, but this situation could cause the Fed to slow down than they would have otherwise had to. All right, I love all you guys. I'll catch you